10-year and the 30-year. What does that mean for the profitability in terms of the big banks that you cover?
It's always a challenge when the yield curve flattens the way it's been flattening this year for the banks. And in particular, it's the net interest margin, which is essentially the spreads that these companies earn on their average earning assets less funding costs. So this 10-year drop that we're seeing today and all year is going to put pressure on that margin. Now, they can offset that, of course, with loan growth. And so the loan growth, as recently as last Friday, it's reported every Friday, we're still seeing about 4.5% year-over-year loan growth, led by the consumer, which is really helpful to those very large banks you just mentioned.
So how should we be viewing a sell-off here, let's call it, in the neighborhood of 3 to 4%? Not that far off from the market overall. I mean, especially given we came off quarters for many of the big banks that were good, if not very good.
That's true, David. In fact, the diversity of their revenue for the largest banks is what really helped in the fourth quarter. And I would say these are buying opportunities. You want to own quality names, and unless you really do think there is going to be a recession here in the United States this year, that would put you on the sideline. But if you're still in the camp that the U.S. economy will be healthy, growing probably around 2%, the banks should do really well in that kind of environment. This interest rate environment is a little more challenging, no doubt about it. But once again, if the economy remains healthy, loan demand should be in this 4% range, which will help partially offset that margin pressure.
Is there a sense that a cut in rates would accelerate loan growth, or is capital already cheap? Then, I mean, another 25 basis points isn't going to make you or I go out and borrow more money.
Carl, I think you're right. I don't think it really would be a drive to stimulate demand. But you bring up a good point. And to David's point a moment ago about the long end of the curve, what you're likely going to see, and we are seeing it in the first quarter, is residential mortgage refinancings have picked up. So once again, these large banks that have the big residential mortgage businesses, Bank of America, JP Morgan, Wells Fargo, all of them should see good numbers in residential mortgage lending, and the housing market has gotten off to a stronger start this year. So that's another positive. But at the short end of the curve, probably not too much.
When you say today, days like today or periods like this are a buying opportunity for banks, do you have specific names in mind of which ones look cheapest?
Sure. When you look at the biggest names, Bank of America, JP Morgan, and Citi are the way to go, in our opinion. Bank of America in particular, because it has such a strong consumer business here in the U.S. JP Morgan has their big investor day tomorrow, so we'll find out more about what's the outlook for them. But on the regional names, the new Truist, that's the merger of BB&T and SunTrust. That one is an added, I think, name that people should look at because the cost savings that they're going to generate from that deal and also any revenue synergies down the road would be beneficial on top of the normal factors that drive stocks.
You mentioned B of A, which just last week raised the notion of negative rates as a risk factor in a filing for the first time. And when Becky asked Buffett this morning, what don't you understand right now? His answer was, we don't understand what happens in a world where $13 trillion of debt yields zero. I mean, how much should we be talking about this here?
Yep. It's going to be interesting because negative rates at the front end of the curve, we don't think it could happen because of our money market mutual fund industry. You might remember when it broke the buck during the crisis, what happened. Now, if the entire world is in negative rates, could the entire money market mutual fund industry be confronted with that, which would be a problem? Negative rates for bank stocks is not good. All you need to do is look at the Japanese banks and the European banks where they trade relative to our banks. So a long end of the curve at 20 basis points, and the front end of the curve at a minus 15, that would be very troubling.
Yeah. Finally, Gerard, I noticed you didn't mention Wells Fargo when you talked about banks you think are worth buying. I mean, the company has a market value below $200 billion. It's down 13% this year. They settled $3 billion last week for the fake account scandal. Why isn't Wells something you think is worth buying?
It's a really good question, David, because it's a work in progress. Charlie Scharf, who's their new CEO, of course, is hitting the ground running. But we have to remember the biggest challenge for them is not so much the payments to the Department of Justice, which, as you just mentioned, happened last week. The bigger challenge is the regulatory enforcement orders that they have. And Chairman and CEO Scharf pointed out that there's 11 of them that Wells is working through right now, with the big one that you recall happened Super Bowl weekend 2 years ago on Janet Yellen's departure. That's what froze the balance sheet, and that's what put the cease and desist order on. So I think he was very clear, the CEO Scharf, that this is going to take time, and his plan is going to be probably finished in turning this company around sometime later this year, and then it's probably going to take all of 21 to put it into effect. So that's the reason we're saying stay on the sidelines. They still have some heavy lifting to do, and when you have alternatives like Bank of America, JP Morgan, or Citi, I think you're better off there.
All right.
Is Sanders a risk factor for the banks, or was that more of an Elizabeth Warren?
I think they both are, and certainly that's one of the industries that is highlighted in the Democratic Party as maybe re-regulating and breaking up the biggest banks. So it is a risk.